looking at the outcome of the decision to determine whether or not the decision was right or wrong. It's called outcome bias. Any one trade doesn't matter. It's the outcome based on a long enough period that goes through multiple market cycles. Focus on the size of the win versus the size of the loss, and then extrapolate that over time.
You are listening to Right of the Chart, the podcast for self-guided, independent traders. Hey everybody, I'm glad you joined the podcast today. I am Sean Vincent. I am the voice of Right of the Chart. Pretty soon we'll be joined by Adam Sarhan. He is the brains behind Right of the Chart. Today we're going to talk about, I think, was a really core fundamental principle, not just to the amped trading strategy, but to anything that you do in life that requires discipline and a plan. And the fundamental idea here is that you don't judge yourself on any one specific result. You're looking for results over time, and that means that you can make mistakes, that you can get things wrong, and if you're a trader, you know that that's going to happen. But as long as you have a proven strategy and you stick to that strategy, it is likely going to give you good results over the long run. We'll talk about that today. And oh, by the way, I recorded this conversation with Adam last Monday on September 16th. But before we get to all of that, remember that in the market, the past does not predict the future. No results are typical, and there is inherent risk when trading in the market. This podcast is for educational purposes and does not constitute financial advice. It is Thursday, September 26, 2024, and here is what's happening this week in the market. Well, by now, the interest rate decrease from last week seems like ancient history. The markets are rallying. The SPY is at all-time highs. The QQQ has broken out over recent highs. Even the SMH is waking up. Semiconductors are back in play. The trading window is open. It's a green light across the board. So, Adam, one of the things, like as a student of the world, I always look for, when I'm learning one discipline, what are lessons from other things that I've done in my life that I can apply to that discipline? And then what are things that discipline's informing about other aspects of my life, right? And one thing I've learned from following the market and managing the model portfolio is that, on any given trade, I might be a winner or a loser, right? But it's not proper to judge the value of that trade on that win or loss. What happens is that the decisions that you make when you have a strategy and a guide for making those decisions over time is how many of those decisions came out beneficially for you, and more importantly, was the benefit bigger than the losses, right? But the success comes when you make good choices over time, and there's some folly in over-analyzing any one particular trade, any one particular decision in your life and your business, whatever it might be.
Yeah, in fact, another way of saying that, Sean, by the way, brilliant observation. Any one trade doesn't matter as long as it doesn't blow you up.
Well, it doesn't blow, as long as you manage your risk.
If you blow up your account, then it matters. Outside of that, people get too myopic and they're caught up in the emotional attachment, the meaning that they assign to that one trade or that one outcome. But in psychology, there's something called cognitive biases, which I'm not going to go too deep in there, but real simple is that if you have a mind, you have biases. There's things that come in that impact your decisions. People always like to tell you, oh yeah, I'm rational. Meanwhile, they're eating chocolate. You're not rational. You know that's not good for you, but you're still doing it anyway. All right, I want the six-pack. I'm not doing the sit-ups. Well, all right. So clearly there's other layers there that impact the decisions. So with one of those cognitive biases, it's looking at the outcome of the decision to determine whether or not the decision was right or wrong. It's called outcome bias. You can Google it or look it up. Yeah. And we covered it in the book. So outcome bias talks about, hey, if this one trade worked, well, then that's a good decision. By working means it made me money. That means it's a good decision. Let me do it 1,000 more times or 1,000,000 more times. Meanwhile, there are other things that impacted the outcome. And in fact, if you go replicate that decision under those same circumstances 1,000 times or 1,000,000 times, you're probably going to get much worse or different outcomes. So it's not a good idea to make decisions based on outcome bias. To illustrate the point in layman terms so everyone can understand it, is imagine it's kind of like I blindfold myself when I cross the street and I don't get hit by a bus. Well, does that
Right.
mean I should go across the street every single day blindfolded? That one time it worked where I didn't get hit by a bus. But is that a good decision? Clearly, the answer is no, because we know that it's not a good idea to cross the street with a blindfold on. So
Right.
when it's not that clear, that's when it becomes really, really important. And the other point that you brought up too, it's any one trade doesn't matter. It's the outcome based on a long enough period that go through multiple market cycles, not just 5 trades or 10 trades and then decide all in a bull market. That's
Mhm.
not necessarily the case. So if somebody grew up in, Florida, for example, they've never seen snow, that doesn't mean snow doesn't exist. They've just never seen it or they've never experienced it. So,
Yes.
that kind of a thing too, where somebody's only
The white
trading.
swan, the black swan. Yeah.
Yeah, the black swan events, exactly, where outliers occur. Someone's only trading in a bull market. They might not know what a bear market looks like or feels like or how much it can go down when things get really bad. After the dot-com bubble burst in 2000 to October of 2002, the NASDAQ fell over, the NASDAQ 100 over 80%. That's $1 was now worth 20 cents, if not a little bit more. That's crazy. But people that never experienced a bear market like that, only
Right.
experienced bulls, might be like, oh, yeah, that's never going to happen. It's never happened. It has happened. They just don't have that experience.
Yeah. And like in practical terms, in recent trading, I'd kept my stops a little tight because I had new positions that had moved into profitability. I wanted to lock in that profit. And I had a sense that things could go down a lot more than they actually did. So I stopped out of things with small profit. A couple things I actually took a loss on, a small loss, and and then of course the market recovered. Some of those things are taken off without me. I feel a little sore about that, but it could have just as easily kept going down, and those protective stops would have prevented me from losing a lot more money. And then one of those, it did go down a lot farther than my stop. So trade by trade, it looks like to an uninformed outsider that some of those were mistakes, right? But I know that type of behavior in aggregate is going to keep me from losing big. And some of those things I can get back in now when they're performing well, and the mistake gets erased over time with success. So
Yeah. Another way, Sean, I know we've spoken about this before, but for newer viewers or people that want to hear it again, there's 2 traders. People ask me all the time, what's your win ratio versus your loss ratio, percent win?
right,
It's the wrong question to ask. There's 10 trades. Trader A loses 9 trades. The 10th trade they win. So they have a 90% loss ratio. Trader B wins 90% of the time and loses one time out of 10, so 10% of the time. So they have a 90% win ratio. So one loses 90% of the time, the other one wins 90%. Which trader or investor would you give your money to?
hmm
Obviously, the one that wins 90% of the time, right, Adam? No, it's incomplete information. How much do you win when you're right versus how much do you lose when you're wrong? That's what matters. So to illustrate the point, if you have 9 trades in a row that you lose one, you lost 90% of the time. But the 10th trade, you win 10. Net, you're up 1. Great. You
right,
made money at the end of those 10 trades. Trader B might have won 90% of the time. They only won 9 times, so they're up 9. The 10th trade, they lose 10. Net, they're minus 1. But they won 90% of the time. Who would you rather give your money to? Someone who's lost 90% of the time but made you money? Or someone who's
right.
lost your money? Clearly the guy who makes you money or the gal who makes you money. So focus on the size of the win versus the size of the loss and then extrapolate that over time. And that's really a superpower.
Psychologically, bring in the P and AMP, psychological analysis, that can get difficult to get beat up a lot, even a little bit, with only one win the game part. You're making me think. I was watching the Emmys last
Yes.
night, and Saturday Night Live, and Lorne Michaels, the founder, creator, and current steward of the show, has been for most of the 50 years it's been on almost, was up for an Emmy against only one other candidate for this category, which was last week with John Oliver.
Okay.
John Oliver won the Emmy, and
Wow.
then one current cast member and 3 famous alum from Saturday Night Live came on stage. and then made fun of Lauren for being such a big loser
That's funny.
because he's lost so many. Right? Of course, the joke is that he's established this cultural phenomenon that's gone on for almost half a century and has influenced all sorts of stars, created stars, and influenced culture, right? And he's won plenty, right? But that's that raised that awareness of the sting of a loss, even when you're an established legend. And that's part of the more I've been doing this. I mean, I understood the psychological analysis part of it, but
Yeah.
now in my discipline, Adam, when I keep my journal and I write about why I'm making every trade, I specifically address what fear or anxiety or other feeling am I recognizing in myself at that time, and how is that potentially affecting my trade, and what am I doing, what am I looking for in my plan that
Hmm.
overcomes what that fear makes me want to do. And it's made me a better trader for sure.
Yeah, I mean that's really really powerful. So in baseball, the people that have the most home runs also have the most strikeouts. They have the record for both. So that's to
Right.
your point about Lauren losing all those times. It still hurts. He's lost a lot, but he's won more than anybody else probably because I don't know anyone else that's been there for that long. Not to
No,
mention
it's
all the other award, the cultural emphasis and all the other great things that man has done. But
yeah.
he's still going to lose, and any great winning trader is going to lose. You're going to have losing trades. It's inevitable. How you manage those losses and then move on to the next win. Those are really, really.
Like
That's
we
true.
say in our house, you have to risk it for the brisket.
Yeah, I like that.
All right, everybody, that is the podcast for today. I appreciate you listening through to the end. It's a little gray back there. Rumor has it that the edges of our hurricane are going to come through here later today, so I'm wrapping it up early, going to get home and hunker down. I'll be back next week with a different guest, someone I think who will have an interesting conversation for you. Until then, keep your losses small and let your winners fly.
As long as it doesn't blow you up.